Let's talk about the concept of securitization. And securitization refers to the transformation of illiquid assets into a marketable capital market instrument. What do we mean by that? We mean that they take things like private debt of homeowners, that is mortgages, credit card debt, student loans, car loans, etc., and they package them together as a security. And they do this because there are people who might like to invest, for example, in credit card debt, but they're not going to go out and look for individuals who have credit card debt and buy their credit card debt. They buy it from the bank, and they buy a large pool of it so that they are well diversified, okay? Or they buy a pool of mortgage loans, student loans, car loans, etc. Now, securitization allows an investment bank to package together a number of risky debts like mortgages and create a new security. And what are some of the advantages of this? Well, it frees up a bank's capital so they can write more mortgages. Okay, banks are constrained in terms of how many mortgages they can write based on the amount of capital they have. But if they've written a mortgage and they're able to sell off this mortgage, then they now have freed up that capital and they can create more mortgages. Another advantage, and the idea that Wall Street or the innovators of securitization came up with, is that the portfolio of risky assets may actually be less risky than the individual assets in the portfolio. So you may be able to take a bunch of mortgages and create a AAA pool of mortgages. Sure, some of the people are going to default, but most of the people aren't. So the security itself is not that risky. Okay, each individual mortgage is risky because individuals do default on their mortgages. Okay, other types of financial institutions have used this forever. Insurance, for example. Nobody would want to write a life insurance policy on just one individual or a homeowner's policy on one house because that individual could die or that home could burn down. But if we write them on a large pool of assets, then there's not that much risk. Okay, some of the disadvantages. Well, because the banks don't have a stake in the loans, they may write loans to individuals who may not be good credit risks. And that's one of the problems that happened, or one of the causes of the financial crisis in 2008. Banks were out here writing lots of mortgages. They wrote a lot of mortgages. Why? Because they didn't hold them. They sold them off. They received fees for selling off these mortgages. So in order to make more money, they just wrote more and more mortgages. So they wrote mortgages where individuals didn't have a sufficient credit history, or they didn't have sufficient income, or for that matter, they didn't even bother to check their income. These no-doc loans, they didn't look for any documentation in order to determine if the individual is creditworthy. It also turns out that the new security may not be less risky than the securities in the portfolio if these securities are highly correlated. If you've studied portfolio theory, you know that you can take a bunch of risky assets and put them in a portfolio, and the portfolio will have less risk than the individual assets, but that assumes that they're not highly correlated. They don't all move up and down together. Unfortunately, the housing market is quite highly correlated. If the economy turns bad, if we're in a recession, lots of people will default on their mortgages. So it's not an individual kind of thing, where in the case of life insurance, the chance that Mr. Jones will pass away is probably independent of the chances that Mr. Smith will pass away. These are independent events, so if we put together lots and lots of people in a life insurance, for a life insurance company, okay, lots of policies, then there's not that much risk, okay, unless you're insuring a whole battalion of soldiers or someplace where something tragic could happen, where everybody dies at once. But if you've written policies for different people in different parts of the country, so they're not all going to die from a natural disaster like a hurricane, then, the risks are pretty limited. So that's a good credit risk, and you can price that risk and charge a premium for it and make a profit. But homes don't work that way. Okay? When the economy turns bad, it affects everybody. Okay? A couple of ways to securitize assets. One is the pass-through security. Here the interest and principal, less any servicing costs, are passed through to the security holder. In this case, one bond class is created so that everybody who buys the security essentially receives the same cash flows. And if we look at a little picture here we have the borrower, for example, the person who, the homeowner who gets a mortgage. The bank sends that person the money so they can buy the home. That person sends their payment to the mortgage banker, J.P. Morgan Chase, Wells Fargo, etc. And those monthly payments are passed through to the people who bought these certificates, these mortgage-backed securities, or these other types of certificates. These people who bought the certificates have an investment with the mortgage banker or the investment banker that created these certificates. Some common agency pass-through securities you may have heard of: Government National Mortgage Association, GNMA, oftentimes called Ginnie Mae. These are mortgage-backed securities. The Federal National Mortgage Association, FNMA, Fannie Mae. Those are guaranteed mortgage pass-through certificates. And the Federal Home Loan Mortgage Association, sometimes called Freddie Mac, have mortgage participation certificates. Now, in the case of Ginnie Mae certificates, this is just a guarantee from the government. They don't actually create loans. They don't actually buy the loans. They just sort of give their good housekeeping seal of approval. Now, in the case of Fannie Mae and Freddie Mac, they actually bought these types of securities. And you may recall from the recent financial crisis that the government placed them in receivership, that they were in great financial difficulty, so the government essentially took them over. These are actually, even though they have federal in their name, these are actually private companies that you can invest in through the stock market, or you used to be able to do that. Another type of securitization is a collateralized debt obligation. If it happens to be on mortgages, it's referred to as a collateralized mortgage obligation. And it's created by securitizing some debt, but instead of creating one bond class, multiple bond classes are created called tranches. Each tranche receives cash flows that are passed through from the debt that is issued to create the CDO or the CMO if it's a mortgage, collateralized mortgage obligation. The cash flow, which would be the interest and the principal, to the different tranches is based on a set of payment rules. So let me show you a little picture here. We've got a pool of underlying assets, and the bank has them. They sell them off to a special purpose vehicle or special purpose entity that's created by an investment banking house. And what this SPV does is, instead of creating one note where all these all the principal and interest is passed through to, in this case there are 4 of these. And you have a senior note, which is AAA rated. You have a B note, for example, which is A rated. A mezzanine note, which is BBB rated. And an equity note, which isn't rated at all. And the AAA note is created because some people are interested in very low risk securities. And so they're going to get paid first. So if there's any defaults on these loans, it's going to be the lower tranches that don't receive their money. If people pay off their mortgages early, okay, or they refinance, that's referred to as prepayment risk. Okay, again, they're still going to get their money, but the lower tranches aren't. The lower down the list you are, the greater the risk. So by creating these different securities, the financial innovators, the investment bankers, are able to create securities that meet different needs of different investors. Some people want high quality, low risk securities. Some people are willing to take greater risk for a bigger return. And so they slice it up into these different tranches. A very good example I saw is a bunch of tiered baskets, okay, or kind of like a water fountain, where the first one fills up. Once it's filled, the water flows into the second one, the second tranche. Once that's filled, it fills up the third, etc., etc. But if payments aren't sufficient to fill up the third tranche, they won't get all of their money, and the equity tranche will get nothing. So that's the basic idea of how it works. And these are obviously much more risky than the basic pass-through securities. Although there's risk in those too, because people do default and there is prepayment risk, but everybody shares equally. Here is the case where some people take very little risk and some people take a lot of risk. So that's the basic idea of securitization. The idea of putting together a bunch of different assets, a bunch of assets like mortgages or student loans, and selling them as a security, as a package of securities. Okay, and again, it's good because it frees up capital for the banks, for example, but there can be risk involved, and these are hard to understand. I mean, it's a nice little picture here, but these can be hard to price out because it's hard to determine the prepayment risk, and it's hard to know if you're down here at the bottom, or if you're not at least at the top, what the likelihood is that you will be paid the cash flow that you expect to receive.